The number that defines your lifetime doesn't fit on a calculator screen anymore. The United States now carries tens of trillions of dollars in official national debt and well over $100 trillion once you add in corporate, household, and unfunded government promises. Global debt, according to the IMF and other major institutions, has blown past $300 trillion. That's more than 3 times the entire world's yearly economic output. On paper, it looks like an accounting problem in Washington, Brussels, London, and Tokyo. In reality, it is the backbone of your mortgage rate, your retirement account, your salary, and the price of everything from groceries to gasoline. Here's the uncomfortable part. Every empire that held the world's safe currency went through a similar debt supercycle. Their endgame wasn't a single crash on a single day. It was a process, a multi-stage sequence you can see in the Venetian ducat, the Dutch guilder, the British pound, and now in the US dollar. In this video, you're going to see that dollar endgame laid out clearly. What each stage looks like, how previous empires moved through it, and where the United States, and by extension the dollar system you live in, really sits today. By the end, you won't just have another scary headline about some enormous debt figure. You'll have a framework to answer a deeper question. Are we at the beginning, the middle, or the end of the dollar's reserve currency era? And more importantly, what does that actually mean for people in the US, Canada, the UK, Germany, Australia, South Africa, and the rest of the dollar-centric world? Every reserve currency story begins the same way. A country becomes the most trusted creditor, the most advanced industrial or commercial power, and the safest place on earth to park wealth. In the 19th century, that was Britain. The pound sterling was as good as gold. The City of London financed railways in North America, mines in Africa, ports in Asia. If you were Germany or Argentina and needed capital, you went to London. Global trade invoices were denominated in pounds because everyone trusted Britain to pay what it owed. In the mid-20th century, that mantle passed to America. After World War II, Europe and Japan lay in ruins. The U.S. held a massive share of the world's gold and industrial capacity. At Bretton Woods in 1944, the dollar was fixed to gold, and other major currencies were fixed to the dollar. For the next few decades, international trade flowed through dollars, central banks built reserves in dollars, oil was eventually priced in dollars, and U.S. Treasury bills became the world's benchmark risk-free asset. For regular people in places like Ohio, Ontario, London, Sydney, Johannesburg, it felt like normal prosperity, rising living standards, an expanding middle class, and steady jobs. Underneath that, stage one always has the same mechanics. The world wants your currency, the world wants your bonds, and the world wants claims on your future production. That demand is powerful, and it sets up the next stage. Once your currency is the world's favorite asset, something subtle changes in behavior. Governments realize they can borrow more without immediate punishment. Investors line up to buy your bonds. Other countries need your currency for trade. Your central bank can issue more liabilities, confident that global demand will absorb them. Britain did this in the late 1800s and early 1900s, borrowing massively for wars, colonial administration, and social programs. Debt to GDP ratios climbed sharply after World War I, yet for a while the pound still felt bulletproof. The United States followed a similar arc, especially from the 1980s onwards. In the early 1980s, U.S. federal debt was under $1 trillion. Over the following decades, it didn't just grow, it compounded. There were tax cuts without equal spending cuts, rising health care and entitlement costs, military interventions, and repeated efforts to stimulate the economy with easier money and credit. By the early 2000s, debt levels that once would have caused panic were treated as routine. Markets shrugged. Treasury auctions kept clearing. The dollar remained the primary reserve currency. That's the hallmark of the imperial credit boom. Debt feels cheap, credit feels permanent, and politicians start behaving as if there is no hard limit. For households and companies across the developed world, this showed up as rising home prices in dollars, pounds, euros, Australian dollars, a cultural shift from save first, spend later, to borrow now, pay someday, and an economy increasingly driven by credit growth instead of productivity growth. But this phase doesn't last forever. At some point, the system tips from healthy demand for your IOUs to dangerous over-reliance on them. That's when financialization and fragility set in. This is the stage where empires start looking rich but feeling brittle. Historically, you see a few clear markers. The financial sector outgrows the real economy. Banking, asset management, and trading profits become a bigger share of GDP than manufacturing, engineering, or innovation. Asset prices detach from incomes. Housing in major cities becomes unaffordable to median workers, and stock markets hit record highs even when wage growth is weak. Wealth concentrates among those closest to the credit spigot: big corporations, financial institutions, and asset-owning households, while younger generations and wage earners feel left behind. Look at the last 20, 30 years in major dollar-linked economies. In the US, the financial sector's share of corporate profits expanded dramatically. In Canada, the UK, and Australia, housing prices outpaced wages for years on end, especially in major cities. In Germany, export surpluses piled up and were recycled into financial claims across Europe and beyond. In South Africa, currency volatility and interest rates interacted with